Hello everyone, North Star VFD Consultancy welcome you to another video on International Financial Reporting Standards for Beginners. This video is part 2 of IAS1, Presentation of Financial Statements. In previous video of part 1 of IAS1, we discussed IAS1 standards, history, its objective, scope and scope limitation, purpose, structure and content of financial statements. IAS1 standard sets out minimum levels of required items to be shown in each financial statement, sometimes specifically on the face of the statement and sometimes either on the face or in the notes, whilst allowing great flexibility of order and layout. According to IAS1, an entity should clearly identify the financial statements and distinguish them from other information in the same published document. In addition, an entity should display the following information prominently, and repeat it when necessary for the information presented to be understandable. 1. The name of the reporting entity or other means of identification, and any change in that information from the end of the preceding reporting period. 2. Whether the financial statements are of an individual entity or a group of entities. In other words, financial statements should identify either they are consolidated one or standalone. 3. The date of the end of the reporting period or the period covered by the set of financial statements or notes. 4. The presentation currency, as defined in IAS 21. 5. The level of rounding used in presenting amounts in the financial statement. Please look into a sample statement of financial position presented here. It is an IFRS compliant statement of financial position of a reputed company. As you glance through the format, content, various sections, you may note that, in first section non-current asset is stated, then current assets, then equity section, long-term liabilities, then current liabilities. Now we look into requirements for statement of financial position in details under IAS1 standard. The information required on the face of the statement of financial position. IAS1 does not contain a prescriptive format or order for the statement of financial position. Rather, it contains two mechanisms. First, it contains a list of specific items for which this is required, on the basis that they are sufficiently different in nature or function to warrant separate presentation. Second, it stipulates that additional line items, headings and subtotals should be presented on the face of the statement of financial position when such presentation is relevant to an understanding of the entity's financial position. The information required on the face of the statement of financial position include line items that present the following amounts. 1. Property, plant and equipment. 2. Investment property. 3. Intangible assets. 4. Financial assets, excluding amounts shown under 6, 9, and 10. 5. Portfolios of contracts within the scope of IFRS 17 that are assets, disaggregated as required by IFRS 17. 6. Investments accounted for using the equity method. 7. Biological assets within the scope of IAS 41 agriculture. 8. Inventories. 9. Trade and other receivables. 10. Cash and cash equivalents. 11. The total of assets classified as held for sale and assets included in disposal groups classified as held for sale in accordance with IFRS 5 non-current assets held for sale and discontinued operations. 12. Trade and other payables. 13. Provisions. 14. Financial liabilities, excluding amounts shown under 12 and 13. 15. Portfolios of contracts within the scope of IFRS 17 that are liabilities, disaggregated as required by IFRS 17. 16. Liabilities and assets for current tax, as defined in IAS 12 income taxes. 17. Deferred tax liabilities and deferred tax assets, as defined in IAS 12. 18. Liabilities included in disposal groups classified as held for sale in accordance with IFRS 5. 19. Non-controlling interests, presented within equity, and 20. Issued capital and reserves attributable to owners of the parent. When an entity presents current and non-current assets and current and non-current liabilities as separate classifications in its statement of financial position, it shall not classify deferred tax assets or deferred tax liabilities as current assets or current liabilities. Current and non-current distinction. An entity shall present current and non-current assets and current and non-current liabilities as separate classifications in its statement of financial position. When a presentation based on liquidity provides information that is reliable and more relevant, an entity shall present all assets and liabilities in order of liquidity. Irrespective of method followed, an entity shall disclose the amount expected to be recovered or settled after more than 12 months for each asset and liability line item, that combines amounts expected to be recovered or settled within 12 months and more than 12 months from reporting period. Current asset. An entity shall classify an asset as current when 1. It expects to realize the asset or intends to sell or consume it in its normal operating cycle. 2. It holds the asset primarily for the purpose of trading. 3. It expects to realize the asset within 12 months after the reporting period, or 4. The asset is cash or a cash equivalent, as defined in IAS1, Statement of Cash Flow, unless the asset is restricted from being exchanged or used to settle a liability for at least 12 months after the reporting period. An entity shall classify all other assets, other than current asset, as non-current assets. The operating cycle of an entity is the time between the acquisition of assets for processing and their realization in cash or cash equivalents. When the entity's normal operating cycle is not clearly identifiable, it is assumed to be 12 months. Current and non-current liability. According to IAS1, an entity shall classify a liability as current when 1. It expects to settle the liability in its normal operating cycle. 2. It holds the liability primarily for the purpose of trading. 3. The liability is due to be settled within 12 months after the reporting period, or 4. It does not have the right at the end of the reporting period to defer settlement of the liability for at least 12 months after the reporting period. An entity shall classify all other liabilities, other than current liabilities, as non-current liability. An entity classifies its financial liabilities as current when they are due to be settled within 12 months after the reporting period, even if 1. The original term was for a period longer than 12 months, and 2. An agreement to refinance or to reschedule payments on a long-term basis is completed after the reporting period and before the financial statements are authorized for issue. When an entity breaches a condition of a long-term loan arrangement on or before the end of the reporting period, with the effect that the liability becomes payable on demand, it classifies the liability as current. Information to be presented either in the statement of financial position or in the notes. An entity should disclose, either in the statement of financial position or in the notes, further subclassifications of the line items presented, classified in a manner appropriate to the entity's operation. The detail provided in subclassifications depends on the requirements of relevant IFRSs and on the size, nature, and function of the amounts involved. For example, items of property, plant and equipment are disaggregated into classes in accordance with IAS 16. An entity shall disclose the following, either in the statement of financial position or the statement of changes in equity, or in the notes. For each class of share capital: 1. The number of shares authorized. 2. The number of shares issued and fully paid, and issued but not fully paid. 3. Par value per share, or that the shares have no par value. A description of the nature and purpose of each reserve within equity. This is end of this video. Thank you for watching, and see you next time with another video on IFRS.